and of course we are back here with another video. So our topic here today, guys, says what went wrong. So what is it that went wrong? So before we continue, guys, remember to subscribe, like, share, and also comment in our videos, and also click that ring button notification so that you get first hand um notifications when we upload a new session. So also remember that um these videos, guys, are mainly for educational purposes, not trading or investment advice. So people should not invest money they cannot afford to lose. So let's get on it now. What went wrong now? So if we look back not so long ago now, the world entered into a global pandemic. So there hasn't been a pandemic in over a century since there was the Spanish flu late in the late 1800s. I think it was the late 1800s, 1895. There was a Spanish flu, and then this pandemic came, which made the world to shut down there. So after the pandemic, there was just huge unemployment. Um, Everything seems to be going down. Unemployment was the issue. Also, when unemployment was the issue, the official unemployment rate, if we are talking about South Africa, since I'm here in South Africa, the official unemployment rate was 32% before the pandemic, and 46.3% among the youth between 15 and 34 were the most that were impacted during the COVID virus. And that's what that number was in 2021. So since we are in 2022, the second quarter, this number has been revised that 66% of the youth in South Africa is not working. So you can see that the impact of the COVID and the impacts of the of the pandemic had a huge toll on our on our unemployment crisis. So if we look back again in time, remember that the government had to do a few things in order for it to to keep the economy going now. One, they did a monetary policy. So when they did monetary policy, they did cut interest rates in order to cap inflation. But this is where the problem started. Also, what did they do? They did some fiscal policies and government spending. That's when they introduced the 350 grant to the people that are not working, of which it was not enough. But now the problem started, as I said again, when they cut the interest rates. So when they did cut those interest rates, what actually happened is that the effects of the interest rates, higher interest rates tend to attract foreign investments, right? They increase demand for the value of the home country's currency and conversely. So low interest rates tends to be unattractive for foreign investment and increase the currency's relative value. So that's when the problem started now. So if we just go a little bit deeper in those interest rates, the effects of low interest rates for personal reasons, it's low borrowing cost, of which it's fine. You can borrow at a low cost. Cheap mortgage payments. If you are paying your bond, it's always cheaper to pay your bond when interest rates are low. And low returns for savers, low dividends of payments, a decline of real value of savings. So people who have savings in their accounts, in their banks, they don't actually see value of their money when the interest rates are low. So that's why in that sense it's low profitability and less profits for banks. So asset prices could rise because the borrowing of money is actually cheap. So a person, since they are not making any money on their savings, what they can actually do, they can borrow money and then they can buy some assets. And then when they are buying assets, because they are cheap, they are cheap. They are buying assets because they are cheap, and it's also cheap to borrow money. And that's why asset prices started going higher. Ne? So for the economic side, ne, the effects of low interest rates, the currency will tend to dissipate, ne, making it exports more competitive, imports more expensive. So if you are buying something from out of the country, it will be more expensive for you. But if you are exporting something again, it is more competitive. So this case could be inflationary pressure. So it brings inflation into the economy. The inflation tends to grow. In theory, it should boost the economic growth, but investment likely to be more desirable. Low interest rates that are low, they should be boosting economic growth, but um, it happens the other way around, that investments tends to be low desirable. So for governments, we'll see relatively low borrowing cost. So if a government go to a bank like the World Bank, they tend to borrow money at a less interest rate. So if you go deeper, what actually went wrong? So in this low economic and low interest rates environment, that's what's happening. There was a huge supply of money in the world. So there was a huge supply of money in the world, of which the US government, what it did, it started printing out those stimulus checks that they were giving to people, right? And also the South African government, they started printing out money, those 350 grants that they are giving out to people. So they are printing this money out of nothing. In order, what they need to do, they wanted to meet the demand at the time, um, to not let the world go into a recession while there's still a pandemic at the time. So they started printing out money at that time. So that's where the problem started. The world, the war in Ukraine was only a catalyst on a problem that was already there, because the war actually, what actually did, it actually increased the energy prices. It actually moved the energy prices higher, but the problem was already there. The problem was already looming there. So the money supply of a country is a majority contribution to whether inflation occurs. As the government evaluates economic conditions, price stability goals, and public unemployment. So we did say that unemployment was the issue when interest rates were cut. So if you go a little bit deeper now, how much money is there in the world right now? So I'm just gonna, I did some digging there, did a little bit of research now. So the Federal Reserve balance sheet at the time, the Federal Reserve balance sheet at the time um was sitting at a certain number, and the Federal Reserve balance sheet is over 7 trillion at this point that we are talking of, that we are recording this video now. And over 40% of this money was added in 2020 alone. Over 40% of the 7 trillion was printed in 2020 alone. It was printed out of nothing. It was backed by nothing. So 40% of the US dollars that are in circulation at this moment, they were printed in 2020 alone. You see how massive that thing is. 40% of the money that is in circulation in the US was printed in 2020, and 40% of that money in the US alone is backed by nothing. So for example, if I could make a simple example of how inflation works, imagine an economy with 100 rand, is with $100, and 100 bananas. If everyone were to take their money and buy all the bananas, the average price per banana would be 1 rand, because there's 100 bananas, and also the economy is worth $100, right? So everyone, if they buy the banana would cost $1 ne. So now imagine the government increase the money supply by 10%. So now the economy is worth 110, yeah? So it was $100. Now the economy is worth 110 US dollars. But this fictitious economy was only be able to be grown by bananas to output by 5%. So 205 bananas. Since the amount of money increases more than the number of bananas, the average price per banana now increased to roughly $105. So I think you get what I'm saying right here. So now the banana has to be $105 more than the actual economic size, because now the government increased the economy or the money supply by 10%. So I think this is just a perfect example of how the US did. So the US economy printed 40% of their money. So now there's an oversupply of money there in the United States. A problem which they created themselves, of which now the whole of the world is getting a shockwave because of this problem that they created. So if you get a little bit deeper here, so now we're having a higher inflation because of the oversupply of money that is there. Globally, there's an oversupply of money that is there. That oversupply of money cannot meet the demand of people because people are unemployed. People are not working. People are not getting salaries. People are not getting paid. So they cannot take in money, maybe perhaps and invest it somewhere, or perhaps buy groceries, or perhaps buy food, perhaps buy oil, gas, gold, all those things. So that thing created inflation. So if you go and look at deeper on inflation, inflation occurs when the money supply of a country grows more rapidly than the economy itself. So the Federal Reserve changes the money supply by buying short-term securities from banks, injecting those banks with capital, right? So in theory, there are situations where the increases in the money supply do not cause inflation, and other economic conditions like hyperinflation or deflation may occur instead. So during the COVID-19, the Federal Reserve materialistically increased the notations of money supply. As a result, the notation experienced higher than usual inflation. So that's why the inflation right now is at its highest moment. It's at its highest times. Everywhere in the world, every huge economy, they are talking about inflation. Inflation is at a 39-year high. Inflation is at a 7-year high. The Japanese yen is at a 34-year low because of our governments. They cannot cater for this major supply of money that is out there. So the only tool that they can use to cap this inflation is raising interest rates. So raising interest rates is the only tool that governments and central banks that they can cap this inflation that is currently going on. So raising interest rates in general, raising interest rates has the performance of the stock markets, number one. So interest rates raised, that means if individuals will see a higher return on their savings. This will remove some money from the stock markets, and then people, they think, okay, I think it's better if I have money saved up in my bank because the interest is already higher than having money in a riskier asset like the stock market. Because if the stock market goes down, I will lose a portion of my money. But if it's there in the bank, automatically it will increase because the interest rate is higher at that time. So this removes the need for individuals to take and add risk by investing in stocks, resulting in less demand for the stock market. So that's why we have been seeing that the stock market has been going down, but the US dollar itself has been going higher because if interest rates go higher and the US dollar strengthens, and we see that if we're looking at the US 10-year yields, we have seen that the US 10-year yields have moved to extreme levels that they haven't been in a long time. So the US 10-year yields moved higher, almost to 3.5%. So we are still seeing that the US 10-year yields could move to the high of 3.8%. So as in line with what the Fed has been saying, that they will increase interest rates rapidly from 2022 leading up to 2023 and up to 2024. And we have seen recently that the Fed has raised their interest rates by the highest number that the Fed chair has ever announced, is 0.5% or is 75 basic points the increase. So also the German 10-year yields, we have seen them rising into we've seen the German 10-year yields moving to higher yields, because inflation is high even there in Germany. Inflation is high even there in Germany, and also they are having an energy problem there in Germany. So we've seen the euro falling in extremely low. The euro has been falling into extreme levels against the dollar, because the demand for the euro was not met. So people were taking money from the stock markets, and they were taking money away from the euro. What they did, they invested it into the US dollar, because it seemed like a safe haven, and then they put money in bonds. So we've seen like the German bonds, they moved as high as the 2% level here. So we are here in South Africa, we are seeing that even our own government bonds here in South Africa, they are moving into some extreme levels, because we've seen that in 2020 when the pandemic happened, in March, the bonds moved as high as 13.2% there in 2020. So we are seeing that maybe history might repeat itself, since the large economies have already increased their interest rates to high levels, and we might actually see another rate hike here in South Africa. Maybe these bonds of the South African government bonds will actually move higher again. So what we are actually seeing here, guys, is that the reality that we are facing is the reality that we are facing as people, the reality that we are facing as the world, is that the problem was created by the central banks, but everybody now tends to be suffering. Central bank created this problem, but now everybody seems to be suffering because of these high interest rates. So high interest rates effects is an increase in borrowing, it reduces investment, and then there's a low economic growth. High mortgage payments, people are going to be paying higher for their bonds or mortgages, and then reducing consumptions, and it also leads to slow economic growth. Increase in rates of saving, but it falls. The increase of rates of savings can go higher, but the housing prices can actually fall, and then maybe the inflation could be curbed. The only thing positive about higher interest rates is they are trying to curb the inflation. That's the only thing positive. But if we move even more to our personal, because we are people, so the effects of high interest rates, it's an increased cost of borrowing, which is bad for us. If you want to buy a car now, it's very, very bad to buy a car, because you'll be paying a very, very higher interest. If you're buying a house now, you'll be paying a very high interest. But it improves the return of your savings, because if you have 10,000 rand in your savings account, but in yearly you were getting a low return, But now, since the rates are going to be higher, you will be getting a higher return on your money ne? So also you'll be paying higher on your mortgage ne? And it increase your bank loan cost ne? So you borrow money from the bank, you'll be paying more on the bank ne? So it also reduces the conflicts of borrowing, the confidence of borrowing. So people will be skeptic to go and borrow money because they know there will be consequences of paying back that money. So, but for the economy, higher interest rates, the currency will appreciate. So, the higher interest rates will help boost the South African rand or will help boost the US dollar. Inflation will tend to be to try to come back to normal. Ne? So economic growth will tend to be slow again. Ne? Unemployment could rise even more on a high interest rate interest rates standard. So government will raise the cost of borrowing. So a high interest rates economy is typically not a good thing. So what I discovered is that the recovery from the recession, the business cycle peaked, but now we are going into something that is called a recession. But the recovery of the recession will be K-shaped. Some parts of the economy will recover, but some parts will be stagnant or even never recover, try to come back again. So to make an example, prior to COVID, everything was rising. But now, since we are heading into a recession, everything tends to be going down. But the recovering phase, the business that are going to be recovering first, the technology parts, technology companies will recover as per normal. Retailers will recover because people will be buying. Software services will be recover because some parts of the economy needs softwares to be upgraded. Some even large institutions needs to their software to be repaired as well. But some industries like travel may be stagnant because people cannot travel, people cannot go on holiday when they cannot afford some basic living things. So entertainment also could be stagnant because like people cannot spend on entertainment when they cannot afford the price of bread. So food services also could be stagnant, and the hospitality industry could be stagnant there as well. So this is called what a K-shaped recovery. Some parts of the economy will large businesses and large corporations could recover fast, but ordinary people or small businesses will take time to recover. So guys, that's pretty much about it, about what went wrong. So it now gives us a picture of what's actually happening in the world. That governments, they cut interest rates because they wanted to cap the world from going into a recession while there's a pandemic. But what actually happened is that they printed money out of nothing. Now that money, there's an oversupply of money. They don't know what to do with that money because people are unemployed. Everything is going up, but people are unemployed. So that money is just there and not doing anything. So now they need to increase some interest rates so they can curb the cost of living, which is inflation. So this video, guys, I hope it will be educational to you. So remember to like, share, and subscribe to our YouTube channel. If you want to join us on our private channel, the Girls Talks is 550, the Gentleman's Club is 550. Then for both forex and stocks is there, it's 850. Then remember, guys, that these videos are for educational purposes, not trading or investment advice. So thank you, guys. I'll definitely see you on the next video. Bye bye.